All right. Good afternoon and welcome to our call today, the 2021 Global Growth Outlook. My name is Greg Patterson. I'm joined with J.A. Kennedy and Mackenzie Sherrard, and we are excited to have this time to share with you today. I hope that each of you are healthy and your families are well. And if you got up early this morning, you were able to take a look at some snow flurries mixed with rain, mostly rain, but nonetheless, it was great to see it. Like I said, we're excited to be with you today, and we are going to talk about a lot of stuff on this call, so we're going to get moving. But before we do, I want to make sure that everybody knows how to submit questions. All you have to do is email Mackenzie at myatlanticwealth.com, and she will be glad to compile your questions. And we're going to have a session at the end to try to answer as many as we can in the time allotted. So during today's call, we're going to provide an update on the markets, the global economy. We're going to talk about the coronavirus and COVID-19, the vaccine, and more. We've got data to look at and a lot to digest. And we'll also give you our forward guidance and some conclusions around our thoughts with this global growth outlook. So with that, let's begin. What about the economy, the U.S. market and the economy? This has been a question that's been on everybody's minds, and certainly in our meetings with clients, we've been asked that a lot. So let's dive right in and take a look at where the markets are. The U.S. market, the S&P 500, has risen, of course, from the March sell-offs last year, and the picture before you shows where they are as of today's date or last night's close. Interestingly enough, Jay and I went to a conference back in February where the leading economists at that time were at the conference, and they had shared their forward outlook. This was before COVID really was a known entity, and they predicted it would be somewhere around 36 to 3,700 on the S&P. And of course, we know what happened from that. So we have surpassed our pre-COVID highs, and much like what we thought. This past week also marks a one-year anniversary of the first COVID related case here in the U.S. So it's interesting to note the timing of this webinar. 10-year yields have been slow to move up, much slower than overall stocks. And you can see that the 10-year Treasury yield has just popped above 1.1%. It was lower than that for quite some time. And we think this trend is a slow go in the future, at least for this year. We don't think that those yields will move up a lot in the coming 12 months. Let's talk about corporate profits, because this is where we think equities and stock prices really derive their gains. The chart that you're looking at here gives us some indication of corporate profits where we are. Incidentally, we just received fourth quarter guidance on the GDP for the US, and that was at 4%, slightly under the consensus at 4.2. Bank of America released a study that said a record $255 billion has flowed into equities over the past 3 months, concentrated largely in the cyclical sectors. And we think that's going to show up here as well to help boost corporate profits. The other part that I wanted to point out on this, the largest positive contributions to the real GDP growth rate in the fourth quarter were personal consumption, residential investment, and business fixed investment. If you've tried to sell a home or buy one, you understand the residential real estate market and the growth that it's having. And we think that spurs many different areas of the economy and will continue to do so for the near term. The Fed and interest rates, the old adage is don't fight the Fed. And if you look at the chart to the far right, what you're seeing here is the overall Fed funds rate. And that, of course, is what dictates the interest that you're earning on your short-term savings, cash in the bank, checking, and so forth. If you take a look here, we're at record lows, and we can see that just in the box above it, the change in real GDP, fourth quarter to fourth quarter, from 2020 all the way out to 2023, and then the long run estimate, as well as the unemployment rate in fourth quarter. Largely, we think rates will be low. The Fed has communicated this. In fact, the quote they used was, "Don't even think about raising interest rates until 2022." And we think that might even extend into 2023. This chart is from FactSet. JP Morgan Asset Management put this together. And it does show an indication of why we think equities and stocks right now are attractive and continue to rise.
Moving along to inflation. This chart here just shows basically a 50-year look at where inflation has been, where it is now. And you can see up here, we've had a 50-year average of around 3.8%. But really since the early 90s, we've been underneath that longer-term average. And we stand here now in the 1.2% range for a headline CPI inflation measurement. We could, as far as where we see things headed in terms of inflation, that's a question we've had come up. We do see that there could be some uptick in inflation as we continue to recover from COVID and continue to boost economic production and recover from the recession of last year. We do feel like the Fed will remain committed to keeping interest rates low, and that will be kept in check. We anticipate a long time recovery in terms of the job market, and feel like inflation will remain in check, and at least if we do see an uptick in inflation, that the Fed's not going to react to that in the near to intermediate term. Which brings me to just speaking about employment and the job market. This chart here on the left, if we look back since 2010, it shows steady growth in jobs added from February of 2010 to February of 2020. We added 22.8 million jobs, and then you can see this precipitous decline. So from February of 2020 to April of 2020, we lost 22.2 million jobs just in that short period of time, couple month time span. Now we have regained 12.3 million of the 22.2 million, but there's still a big gap there for us to make up for from an employment standpoint. Unemployment was in the high teens at the worst of the COVID impacts, and it's now we're under 7%. We're at 6.7% on unemployment. This chart here on the right shows that there are still areas where we have not recouped, jobs. So the largest or biggest impacted area is the leisure and hospitality industry, where only 59% of jobs have been regained in that industry. So that would be an area where we would look, if we're able to get past COVID, we could see improvement there. As far as federal finances, the debt and our budget deficit, there's a lot on this slide to digest. On the left here just kind of breaks down the breakdown of federal government spending. So you can see there's entitlement programs there, Social Security, Medicaid, Medicare, that type of thing. But I really wanted to focus on the right, these two charts. The one at the top right, this shows our federal budget surplus or deficit, which you basically should just fill in the blank as deficit instead of surplus from where we stand right now, but as a percentage of GDP. So you can see here we jumped up for 2020 because of COVID spending and stimulus to 15.2% of GDP in terms of our annual budget deficit for 2020. And then also where the where the CBO forecasts that, the Congressional Budget Office, over the next 10 years or so. So we are expected to drop back down from the 2020 levels, but still be running a deficit that runs somewhere along the lines of 5% of total GDP. So that's 5% of our total economic output for each year. I think one encouraging thing about this chart is going back to 1990. We do see that there has been an ebb and flow to this. So we have had spikes, and we've also been able to recover from those spikes. So hopefully we would be able to do that in this case as well. And then at the bottom here, this is federal net debt. So this is our GDP. Again, that's our total annual production or output as a percentage our total debt as a percentage of the total production. And we have hit the 100% figure. So for the longest time, we were there a ways back. If we look back in time, we did go over 100% in terms of this measurement, but it's been quite some time that we've stayed below that. So we'll point this out because it is something to keep in mind as we look to the future, where we can expect just the country being from a fiscal responsibility standpoint and a budget deficit and just an overall deficit that we run. Jumping over just to the equity market and valuations, you hear people talk about, some folks say, well, the equity market is way overvalued now. We shouldn't buy into equities. And this chart is valuation measurement. It looks at forward price to earnings ratio. This middle line is kind of the 25-year average of price to earnings ratio of the S&P 500. By this measurement, we are above average. As you can see, the average is 16.56. We're at 22.33 times. This chart taken by itself would lead you to that conclusion that we're kind of high in terms of equity market pricing. But there's, in this box here, there's several other measurements of valuation. And there is one that is important based on conditions currently, and that is the equity market relative to the bond market. That's this equity yield spread, and that actually shows that the market is undervalued from a equity market compared to bond market scenario. So we can't just take this one chart just by itself. We have to factor in the other economic conditions and other areas of investment. Which brings me to this, this slide here talks about cash account returns. So returns on $100,000 invested over time. It goes back to 1994. The gray bars is basically the income generated, annual income generated in a savings account with $100,000 in it. The blue bar is the income needed to beat inflation. So you can see there are years where you could stick your money in a savings account and beat inflation, but that hasn't been the case for quite some time. And in fact, we sit at a worse spot than we've been in a long time currently, where you could put $100,000 into a savings account and earn $200 for the year, but inflation is running about $600, a year. You'd have to realize that to just maintain from a purchasing power standpoint. So this is one of those other factors that we take into account when we consider, is the equity market in a bubble? Is it valued too high? piggybacking off of that slide, the question begs itself is, what do we have a lot of money sitting in the bank, in money market accounts on the sideline right now? And the answer to that question is yes, we do. This goes back to 2011. You can see total money market funds were running around $3 trillion until we had a slight uptick here into 2020. But this spike is basically COVID, right? Money selling out of the market, going into money market funds, bank savings. And we went from around or under $4 trillion to over $5 trillion in money market funds, record levels. And you can see there, while it's come down a little bit from the highs, we're still at record levels in terms of funds that are sitting in money markets currently, earning, as we talked about, $200 a year on 100,000, maybe if you're lucky.
Yeah, and so that inflation component, I think that slide was a good way to look at the impact, not necessarily what you see on a bank statement or a savings statement, but the reality of 0% policy and what that does for you. So that was good to be able to see that. The U.S. economic growth, gross domestic product, on the right-hand side, it's made up of the 4 different areas plus the net exports. The net exports were the negative producer of the bunch in terms of the components of that. The biggest component is consumption, so retail, sales, spending, and that's 68, almost 70% of the equation, followed by 18% government spending, 13% investment, not counting housing, and then housing. So the gray bar would be business investment and that type of thing. If you look to the left of the chart, you can see the blue dotted line is the trend growth at 2.5% going back to the fourth quarter of 2016. The bump there that you see, of course, is related to the recession we had, the short recession on the backside of the shutdown due to COVID. And it has come back up, but we do have a ways to go. Like I had mentioned earlier, fourth quarter GDP was at 4% annualized. The third quarter shows up in the box right above the chart. So you can see that quarter over quarter seasonally adjusted. And that's 3Q 2020 is a 33% to make up for the huge dip we saw in second quarter. And of course, there was a dip in the first quarter. January and February were great months last year, but were negative in March. So that did impact that first quarter. The good news is we see this trend improving and going up. And we think we do have a ways to go, but we believe that's improving largely based on the real estate and the consumption figures. Even looking at the Purchasing Managers Index suggests that there is good news from business spending. Jay and I look over on a regular basis the leading economic indicators. The abbreviation is LEI, and that is put out by the Conference Board monthly. They update numbers monthly. They have leading, like looking out the front windshield of a car, and lagging or trailing indicators. So the leading indicators in this chart is the blue line. The red columns represent recessions, and the years are at the bottom. So if you just follow that along, these are leading economic indicators. You can see it basically fell off the cliff in the early part of 2000. So a major surprise and a shock to the system. We all understand why. The impact of that, of course, is being felt still today, but the LEI index that updates every month takes a grouping of about 10 different metrics that are forward-thinking in nature based on what the economy is doing. And it does show us improving consistently. So that's good news there. If you take a longer term look at that, what we just looked at was a shorter term, but if you take a longer term look down at the bottom left hand, you can see 60, that's 1960, all the way to November of 2020. This is the leading indicators with the trend line. If you take a look at the gray bars that are the rows there, those are recessions. So you can count them going back to 1960. There was a thin line last year, a very short recession. And you can see over time that trend is up with these cyclical cycles, in there. They're not, it's not a crystal ball, obviously, just like we had mentioned last year was a complete surprise, but a lot of times you can see from these leading economic indicators where the economy's going before we actually get into that recession. In fact, in most cases, that has been the trend to actually signal that before you wind up in a recession. So that's a good chart. We follow that on a monthly basis every time they update it, and it gives us good insight into what's taking place. Let's talk about Purchasing Managers Index. So let's see here. Before we do that, let's go over the housing information here. And this is just a chart of 30-year fixed rate mortgages across the US. If you've bought a house recently, you know they're incredibly low, record lows, unbelievable. Hopefully, if you've had a mortgage, you've refinanced it to capture some of these incredible interest rates. And if you hadn't refinanced it, you may be close to paying it off where it might not make sense. But certainly that is a trend that is in line with the growth in the real estate market and the pricing on residential real estate. Maybe not so much for corporate, of course, but for residential, we think that continues in the near term as well, just supported by the Fed and these low rates. So let's now hop over to Purchasing Managers Index. So the Institute of Supply, the ISM Index is one thing that we look at as well. It tracks services and manufacturing and gives us an idea of how things are performing. This chart goes back to 2000, so it gives you roughly a 20-year perspective of that. Anything above 50 is an expansion. It signals an expansion in the business sector on what is being spent by businesses. If it's below 50, it's a contraction. And in many cases, you see them move tandem on those recessionary time periods, which are the gray bars. So this, again, while it's not a crystal ball, it does help us look and see what might be happening in consumption on the institutional side of things. And if you notice the far right side of that chart, we are over 50 and we're trending upward on these leading indexes. And that again gives us a little bit of cautious optimism with where we are headed for 2021 this year. And so new orders is another key part to keep in mind. What are people ordering in terms of Purchasing Managers Index and inside of companies and businesses to fill back up shelves. And certainly with today's business climate of just-in-time inventory, this is a real good indicator on where we think we're headed on spending and consumption. So again, over 50, it's signaling an expansion, and below 50, contraction. We think the noteworthiness of the right-hand side of that chart leads us to believe that we're going to continue to do well on that new orders index. The next chart, we'll take a look at asset class returns. So this is shifting gears to really look in the rear view mirror, but also help us to see the benefit of asset allocation and the role that plays in a well-constructed portfolio. So if you take a look at 2020, this column over on the right-hand side gives you a ranking, but basically the different colors are the different sectors of the market that you could invest in. For example, at the very top, small cap, this is growth, blend, and value. Those companies were up 20%. as an asset class for last year, the best performing sector. The year prior, it was large cap, growth value blend. This previous year, this would be the S&P 500, for example, that percentage was over 18%. So those top three might not necessarily be the top three as we go forward, and they do change places. I think the color helps us to see that. The REITs are real estate investment trusts. Those did not fare so well last year. In fact, they were the leading loser, and primarily because of a more work at home type of scenario that has been taking place. I can't even imagine what corporate real estate looks like in the bigger urban cities. It makes you somewhat appreciate living where we live. We do have open office spaces, but not like those urban centers. So that, of course, is the reason why those rates are down. An asset allocated portfolio last year with a combination of all of these weightings produced a 10% return, and certainly smoothed out the line from the highs and lows looking back to 2005. So again, the benefit of not trying to time the sector or the market, but again, based on your risk tolerance, if you were an asset allocated investor, you could have captured some of the upside and minimized some of the downside here. As we see for 2006 to 2020, annually, the best one was large cap. And then as far as the worst one, commodities. So the question comes up, is now the best time to buy gold? We think over a long period of time, gold has not been a very good place for money. It's a store of value, but doesn't pay a dividend and those types of things. So, you know, you hear a lot of that now, especially where there's bigger days in the market, you know, bigger swings in the market. But we think that buying good quality companies that produce dividends is probably the best way to go as we look into this year. All right, so we showed this slide in the fall last year. We probably needed to adjust it, but I'll let you take a look at it again. The Fed is over on the right-hand side. She's helping the stock market. In fact, she's using both hands to hold up the stock market. The value investor last year was just trying to stay above water. We think there is some sector rotation that's taking place this year. The value investor has come up a little bit, but it still looks like mainly it's growth, tech, healthcare, those areas that are doing very well and look to be doing well in the future. Probably financials this year as well. We've seen some of those prices start to improve just over the last few months, and in the energy sector too. So noteworthy though that the Fed has been one of those things you just don't want to fight. And so it has put investors in a position to choose stocks and equity-like returns over others like fixed income and cash.
All right, so what about global markets and economies? We want to just take a few minutes and briefly just touch on the global markets outside the US. And this chart here just it really shows the projections for 2021 from a global economy standpoint on the left. So overall, this includes the US and emerging markets, developed markets. Projections are for about a 5.5% growth in output for 2021. You could see we're down 3.5% for 2020, and then for 2022, 4.2%. That extrapolates out to advanced economies and emerging markets and developed economies. You can see advanced economies at a 4.3% projection growth rate for 2021, and emerging markets a little better at 6.3%. This chart basically drills down into the details of that previous one to look at for those advanced economies. Here are the countries and the areas that are included in that. So the US, of course, is an advanced economy with expectations of 5.1% GDP growth for 2021. You can see there are a couple others in the 5% range: France, Spain, Japan at 3, UK at 4, Canada at 3.6. But overall, that 4.3% growth expected. From an emerging market standpoint, you can see here where India is at 11% expected growth, China at 8%. So there are some here that are on the higher end in terms of growth expectations going forward for 2021, and then here for 2022 as well. I think it's interesting to look at this and then think about that in terms of how that impacts our investment allocation and where we're trying to look forward to where Greg always said, skate to where the puck is going, not where it's been, right? So that's what we're trying to do in going through all of these things. This slide really just points out and highlights the fact that we still have a ways to go, even though we have recovered from last March, April, May timeframe. This shows 2020 projections, comparing them now to where they were before COVID. So the fact that all of these for each country and each area is negative just shows you that our projections today for 2022 are less than where they were prior to COVID. So it is going to take time for us to fully recover, but I think that also speaks to the opportunity for us to continue to see, gradually increasing and positive results coming from not just the U.S., but around the world as well. And then from a valuation standpoint, this chart on the left addresses emerging markets as compared to the U.S., the S&P 500 from a price to book ratio valuation measurement. And you can see here that with this middle line kind of being average, that we're below average. So that would lead you to believe that emerging markets are undervalued and as compared to the S&P 500. And similarly with developed markets, developed international markets, as compared to the S&P 500. This is the price to earnings measurement. So what do we expect earnings to be over the next 12 months? And you can see that a similar trend there, that in comparison, that international developed markets are cheaper than the S&P. That's not to say that we're not still bullish and optimistic about the U.S., because we definitely are. But there could be, while the U.S. is, for a long time, the U.S. market has outperformed international. We could see, the ability to earn some additional gains in international going forward, especially in emerging markets. So.
All right, so we've had the election, the inauguration took place, and we're on the back side of that. We had shared at our election webinar last year just a couple of key themes and some history behind that. And it's been coming up in our client meetings this January, just going and sitting down with clients, either digitally or in person. So I wanted to bring that back up and show you that the history on that. And this is just a slide to show how well markets have done based on who was in control of the White House and Congress, both houses of Congress. So this is the S&P 500 from 1928 to the present. And so right now we're with a Democratic president and a Democratic Congress, and that's happened 35 times. And the markets have averaged 14.1% per year since that time. That's actually been the most number of years that that's occurred. Certainly not the best rates of return, but right in the middle. And the stock market is just a forward indicator. It's a leading indicator in itself of what's going on in the economy and the marketplace, how investors are feeling. It takes consumption and consumer confidence and those types of issues, I think, are known already now. And this number can help us go back to what we had shared with you in the fall to say more than likely we're going to have a reversion to the mean here on Democratic president and White House. That's not a crystal ball, mind you, but it's simply taking a look over the broad time span of seeing how that's been impacted before. And then also from our fall webinar, what happens regardless of the winner of the election. So we know who won, but let's take a look at what we shared with you back in the fall. We still tend to think that these themes are where we should be focusing on for 2021. So first of all, innovation in biotech and the technology sectors. The tech sector was the #1 performing sector last year. We think behaviors, whether it's shopping online or working from home, all spur growth in those sectors, and those two will be winners this year. We believe there's a focus and attention on U.S. infrastructure. We hope that even translates to Arundel Street and Bridges Street, because I don't know if you've driven down either one of them, but it's awfully bumpy. But those types of things, roads, bridges, railways, those infrastructure expenses are going to take place. Continued low interest rate environment. Again, we don't see the Fed moving rates until the employment picture looks better. Increased government spending, that's pretty known right now, but we still believe there's going to have to be debate and some compromise over that. But again, coronavirus relief, infrastructure, and elsewhere, there's going to be funds spent. And when that money hits the economy, we believe that it will be a boost to equities and stocks and to the U.S. economy. Revitalization of U.S. manufacturing. So continuing on a theme of jobs here in America, we're still believing that that's going to happen. Continued economic recovery. Again, it's going to take us a while to get back on the 2.5% GDP trend, but we see that that's going to be a continuation. And then inflation in the long term. Anytime you put stimulus, large amounts of stimulus in the economy, we think it is going to have an inflationary impact. I had a client tell me just today that he went to buy bologna and it had gone up 30% just from the last time he bought it. I don't know if that was a month or a quarter, but you know, we've seen it in building materials and other things. We think some of that's partially due to COVID, but others, certainly in the real estate market and so forth, are due to just the demand there. So that's regardless of the winner. We think those themes would continue on and would be sectors that we would want to invest in for positive gains for this year. And then, of course, we also shared some biblical wisdom and truth around leadership. And it comes from Romans 13:1. Let every person be subject to governing authorities, for there is no authority except from God, and those that exist have been instituted by God. So some truth there that we want to hold on to. Let's talk about COVID. We look at a COVID tracker. This comes out, it's a really neat chart. It's the daily reported new COVID cases and deaths, and then they trend that on a 7-day moving average. So if you go to covidtracking.com, all the data is there. It's a great website, gives you an up-to-date look at it. First Trust actually compiles it in a snapshot so that you can see going back to February how those numbers looked. The orange line, I guess that's an orange color, darker yellow, orange. That measures the daily deaths over a 7-day moving average. And then the shaded orange, I guess a peach color, gives you the daily reported deaths. And so those have spiked up. The trend, has gone up over the last couple of months. But we're optimistic with the vaccine that those will begin to come down. The blue line actually reports the positive cases. So that can kind of give you a lead indicator to deaths based on the number of positive cases. And those have trended down for the 7-day moving average. So it has shaped our world in ways we never thought possible and certainly didn't dream about but we're living it now. And I know many of you are making the best of it. And, it's something that we are optimistic we're going to get on the backside of this, and we're going to go on to see better days. And so we're looking forward to that.
Yeah, that's a good segue. I want to just touch on vaccine distribution first, and then hit on again on reasons to be optimistic from a coronavirus standpoint. So this just goes back, it's about a week and a half old in terms of data, but with regards to daily vaccinations in the U.S., so we were running around a little over 800,000 shots per day on a 7-day rolling average. You can see there, even earlier in January, there were some days where we were over a million in terms of doses. But Biden has talked about 100 million doses in his first 100 days. And I think based on where we are now and this focus on ramping up the numbers, that's probably very, very realistic for us to be able to get to that point, 100 million doses in the first 100 days. And I'm going to talk about the implications of that in just a second. The risk of death by age from COVID. So this is as of January 9th of 2021, but just breaks down by age band, age group, the population size in the U.S. This is just the U.S. and the percentage of the population who have died from COVID. So you can see it's definitely skewed towards those in these older age brackets. With total population size of 328 million, 6.6 of 85 and older, and about 1.6 have passed away from COVID, unfortunately. As far as hopeful prospects, so remember this chart, because this is kind of an inverted portrayal of that chart. So and it kind of goes from bottom up. So 85 and older, 6.6 million people. 75 and older, this number is basically adds those two categories. So 22 million people in the US are 75 and older, 54 million are 65 and older, 55 or 96.5 million are 55 and older. And on the right, this shows you cumulative death percentage. So of all the COVID deaths, 92.7% have been amongst those 55 years old and older, which is about 96.5 million total. So to think about 100 million vaccine doses administered in 100 days, and we've got less than 100 million in this category, 55 and older, that encompasses about 93% of all COVID deaths. Mm-hmm. That seems to be very encouraging. The way I see it, if we're able to realize that and get vaccines, put into those that are at the highest risk of death, that we could be sitting, at a much different point a few months from now, even just a few months from now. And this chart just piggybacks off of that as well. The blue line on these bars are positive tests. It goes back to December 20th through January 20th of 2021. And the gray bars are what the CDC estimates as infections, positive cases that have not been tested and identified, with the green bar or the green piece of the bars being those that have been vaccinated. And this on the left is just millions of people, so that's our population. You can see between 35 and 40% have already either received vaccination, had COVID, or are projected or estimated, to have had COVID. So in thinking about, putting injecting or implementing 100 million doses over the next 100 days and adding to these numbers already, that should make us feel encouraged about where we could be, on the backside of a few months down the road. So that's my closing optimistic thoughts.
I like it. So in the just a minute or so we have left, conclusions, we think the U.S. economy is expected to continue to continue its recovery with GDP growth and earnings growth in 2021. We've shared our thoughts and painted the case for that. The leading economic indicators are currently positive, and the trend line looks positive as well. The equity markets have rallied, so we've seen that. We've seen monies come into equity markets just from the Bank of America survey, and those continue to help supply do really well. For value investors, last year was a little bit frustrating, but we have seen some reversal in this trend. So we believe that dividends will continue to be an important part of a portfolio. Relative to bonds, stocks appear inexpensive, and there are insignificant or significant forces at play pushing down yields. This is for the long term, so we don't think that a fixed income portfolio would be the right way to go at this time period. And we believe you watch the Fed and continue to pay attention to what they're doing with the rates. Assuming the filibuster in the Senate is kept in place, we believe that Congress may have to have some bipartisan support there. Compromise. It's not a common thing in politics, but I think some gridlock might actually be good in certain ways. There are reasons to be optimistic about COVID. So we've shared those in terms of vaccine and the distribution of that. We think that there's some pent-up demand too. Many of you on this call might be just ready to take a trip or travel, and that's certainly going to help the leisure and hospitality industry and some consumption as well. So these powerful themes will emerge and continue to perform well for those equity investors and those who have money invested for the long term. In the short term, I think it's tough on short-term reserves, cash, and those types of things, but we are finding creative places to put cash to help with that. So those are our conclusions. We want to remind you, if you have questions, to email them to Mackenzie. That's MACKENZIE at myatlanticwealth.com. And she will sort through those and give us a couple of questions here in the time that we have left. I appreciate everybody being on the call. Just to give you a heads up, Mackenzie, J.A. and I and our families are healthy and we're doing well. We certainly have enjoyed talking with our clients who are on this call and those that we have the pleasure of serving, and hearing their stories of how they've been making the most of these times, whether it's just being more intentional about connecting with grandkids over digital media, or even cleaning out those closets that have been neglected over the years. So a lot of that stuff's behind us, and we're looking ahead for a better day and a better year. So our hats off to you. We are very blessed to be able to serve you and be a part of your life. And we thank you for joining us today. And with that, Mackenzie, any questions?
Sure. Thank you, Greg. We do have some questions coming in here. We'll start with this one. We have accumulated more than we need in short-term savings. What is the best thing to put that in to earn more interest?
Yeah, that's a good question. I mean, it is specific to your situation. And it's not uncommon if you haven't been traveling or spending money to have accumulated cash. I mean, there's a variety of vehicles. You used to be able to put that in CDs. Now I think just looking at even preferred stocks might be a good place for some short-term cash that pay good dividends. It is tough though. We would want to sit down with you and make sure that your situation and what your goals are and your risk tolerance level, we're comfortable with that type of strategy. Yeah, because 100,000 generating $200 a year, that's where you used to earn $19 a month. Now you're earning 19 cents. That's not too exciting, is it?
Great. We'll do another one here. This one says, should we be concerned about rising prices?
Jay, you spoke about that. Do you want to take that one?
Yeah, so we haven't seen that to this point, and I think we would expect we could see some rising prices, but we expect inflation to remain in check in the short to intermediate term. So longer term may be a different scenario, but we expect prices to remain in check at current levels, or maybe slight rising of prices.
Okay, awesome. And then we have one more here that we'll do. It says, is the federal debt level a problem for stock investors?
That's a good question. I think it could be, definitely. Jay, there was a chart in there that you had. I don't remember what page it was on, but it had the top right, the federal debt and the deficit. The two there are different. Of course, the deficit is what what we're short from what we take in federal expenditures or federal income rather through taxes, and the expenditures, that is the deficit. That one, that's it, yeah. So the bottom one is the debt, and of course you can see how it has climbed up and probably will continue to do so on the backs of stimulus. Hasn't always climbed up, and we can work our way down with economic growth. That's going to be a hard one to tell. I don't think that stock prices move in tandem with the federal debt. I think historically we've been a debtor nation. There have been times back in the 70s where that got down to a low percentage of GDP, but GDP has continued to grow. So I don't think stock prices move in tandem with the debt. Any thoughts on that, Jay?
Well, I mean,
just
to reiterate that with the Fed interest rate expectations going out to 2023 on maintaining rates at basically zero, as long as that's the case, we would not see that being a huge impact on equities, again, in the short to intermediate term.
Right. Yeah, I mean, I think it's a good case for why you do diversify. You shouldn't just own stocks, but you need to make sure that you've got reserves set aside, even for the unknown. I think it's a good case to look, especially as we look into this year, at maybe increasing some international exposure. So there are ways to hedge against that. It's anybody's guess as we go forward, how that looks, but I would expect that taxes may go up. And so that could be a way to offset some of that. Good questions. I think we're about out of time. Appreciate you joining us. If there's anything we can do for you, feel free to give us a call or email us. If you have questions after we end this call, certainly email us. My email is greg@myatlanticwealth.com, and ja@myatlanticwealth.com is JA's email. We're happy to answer and respond to you. Also, if you're on the call and you're not a client and you'd like a second opinion, we'd be glad to sit down with you, either digitally through Zoom and a video conference or a phone call, or in person with masks. We'd be glad to go over your situation and talk through what might be most important to you and help you make sense of what we've talked about today. Our phone number is 252-515-7800, and you can find us on the internet at myatlanticwealth.com. And it's a joy for us to be able to serve you. And I hope you and your family have a great day and enjoy the rest of this week. Take care.
Bye-bye. Thank you.